What if I told you diversification might actually be making you poorer? Not because it's wrong, but because you've been taught it wrong. Most people think diversification means buy a bunch of different stocks and you're safe. That's not diversification. That's just owning multiple ways to panic at the same time. Today, we're breaking diversification down, not like a textbook, but like someone who actually wants to build wealth. And by the end of this video, you'll understand why owning 20 stocks can be riskier than owning 3, why diversification sometimes fails exactly when you need it most, and the one version of diversification that actually protects you. Let's begin. Textbooks say, don't put all your eggs in one basket. Sounds smart, but here's the problem. Most people interpret that as, if I buy Apple, Microsoft, Google, Amazon, Tesla, and Nvidia, I'm diversified. Are you though? Because when the market crashes, they all drop together. In 2020, in 2022, in every major correction. So if everything falls at the same time, were you diversified? Or were you just concentrated in one system? Here's the uncomfortable truth. Diversification isn't about how many assets you own. It's about how differently they behave. And that difference is called correlation. Correlation is simple. If asset A goes up when asset B goes up, they're correlated. If asset A goes down when asset B goes down, they're also correlated. True diversification only happens when assets move differently. For example, stocks and bonds sometimes move differently. Stocks and gold sometimes move differently. US stocks and emerging markets sometimes move differently. But here's the catch. During crises, correlations spike. Everything falls together. That's why people say diversification doesn't work. It does, but not the way you think. Diversification reduces normal volatility. It does not eliminate systemic risk. That's a big difference. Let's rewind to 2008. You owned US stocks, international stocks, real estate, and financial ETFs. You felt diversified. Then Lehman collapsed. Guess what happened? Everything tied to the global financial system crashed. Because your assets weren't independent. They were connected to the same economic engine. That's called hidden concentration risk. You weren't diversified. You were leveraged to one global credit system. True diversification would have required cash, treasuries, possibly gold assets outside that system's collapse. Diversification is about different risk drivers, not different tickers. Owning 50 stocks feels safe. Psychologically, it reduces regret. If one stock fails, you say, good thing I had others. But mathematically, after about 20 to 30 stocks, you've already captured most diversification benefit within that asset class. Beyond that, you're just mimicking the index. And if you're mimicking the index, why not just buy the index? This is why index funds became dominant. They accept market risk. They remove company-specific risk. But they don't remove economic risk. That's an important distinction. Now let's make this simple. There are 3 real levels of diversification. Level 1. Within asset class, owning multiple stocks in one market. Level 2. Across asset classes, stocks, bonds, real estate, commodities. Level 3. Across risk regimes assets that perform in different macro environments. Inflation, deflation, growth, recession, liquidity crises. Most people only do level 1. Smart investors think at level 3. Ask yourself, if inflation spikes, what wins? If recession hits, what wins? If rates crash, what wins? If geopolitical shock hits, what survives? Now you're diversifying properly. Now here's the controversial part. Too much diversification can destroy wealth. Why? Because it dilutes conviction. If you truly understand a business, if you deeply understand an ETF, why allocate 2%? Warren Buffett once said, diversification is protection against ignorance. That doesn't mean diversification is bad. It means if you know what you're doing, concentration increases upside. But here's the reality. Most people overestimate their knowledge. So they concentrate emotionally and diversify accidentally. That's the worst combination possible. Here's a more intelligent way to think about it. Instead of asking, "How many assets do I own?" ask, "What risks am I exposed to?" For example, are you exposed to US economic growth? Are you exposed to interest rate risk? Are you exposed to inflation risk? Are you exposed to liquidity risk? Are you exposed to geopolitical risk? If your portfolio only wins when tech stocks rally, you're not diversified. If your portfolio survives multiple economic environments, now you are. Diversification is about survival, and survival compounds. Here's what nobody tells you. Diversification's real job isn't maximizing returns. It's keeping you invested. Because the biggest risk isn't market volatility. It's you, panic selling, chasing trends, overreacting to headlines. A properly diversified portfolio reduces emotional volatility, and emotional stability is alpha. The investors who win long-term, they don't have the highest IQ. They have the highest endurance. So no, diversification isn't own a bunch of random stocks. It's this: own assets that respond differently to different futures. Because the future is uncertain. And the only free lunch in investing is intelligent diversification. If this changed how you see your portfolio, you're already ahead of 90% of investors. Now the real question is, are you diversified? Or just comfortable?